It wasn't a hypersonic missile test. It wasn't a naval blockade into Taiwan Strait. It wasn't even a cyber attack on the power grid. It was the sheer, merciless weight of industrial capacity. The pattern is unmistakable. History does not deal in subtleties. It deals in arithmetic. When a dominant power hollows out its productive base, when it relies on financialization rather than manufacturing, when it uses the privilege of its currency to fund deficits that can never be repaid, it creates a vacuum. And nature abhors a vacuum. The challenger does not need to be perfect. They only need to be solvent. They only need to produce the tangible goods the world actually needs, while the incumbent produces debt, while the incumbent produces paper. This is not a political statement. It is a historical cycle. A cycle that has destroyed empires far more entrenched than the current order. The rise of an $18 trillion rival economy is not an anomaly. It is the inevitable reversion to the mean. The data suggests we are watching a tectonic shift in the center of gravity, from the Atlantic to the Pacific, from the consumer to the producer, from the debtor to the creditor. The mechanism of displacement is always the same. It begins with trade. It moves to currency. It ends with geopolitical reality. The incumbent ignores the threat, then they underestimate it, then they try to sanction it. Then they realize the leverage has already shifted. The arithmetic is merciless. You cannot print your way to supremacy. You cannot borrow your way to security. Eventually, the bill comes due, and the creditor sets the terms. To understand where this leads, we must look backward. We must examine the graveyard of empires that thought they were exempt from the laws of economics. The pattern repeats with terrifying precision. We will examine 3 specific case studies: the Roman Empire, the Spanish Empire, the British Empire. Each followed the same trajectory: peak dominance, unsustainable costs, a monetary shortcut, and finally, the rise of a challenger who simply produced more, saved more, and owed less. Consider the Roman Empire in the 3rd century. Under the Pax Romana, Rome was the center of the world, but the costs of maintaining the empire grew faster than the economy. The legions required payment. The bureaucracy required funding. The emperors, beginning with Nero and accelerating through the crisis of the 3rd century, chose the path of least resistance. They debased the currency. They mixed copper into the silver denarius. They thought they could create wealth by clipping coins. But the market knew better. Inflation soared. The complex trade networks that fed Rome began to disintegrate. The legions, realizing the coins were worthless, began demanding payment in goods. Land. Cattle. Sold. A Roman soldier stationed on the Rhine into 70 AD wasn't thinking about the glory of the empire. He was thinking about how his pay couldn't buy a loaf of bread. The periphery became stronger than the core. The productive capacity shifted to the provinces, and the center collapsed under its own weight. Just like the Roman Empire, the Spanish Empire of the 16th century fell into the same trap. Spain controlled the greatest treasure in the world, the silver mines of Potosi in the Americas. They had an endless supply of money, but they made a fatal error. They used that money to buy things, not to make things. Spanish industry withered. Why build a factory when you can just import cloth from the Dutch or the English? The influx of silver caused the price revolution. Costs skyrocketed. The Spanish middle class was crushed. A shoemaker in Castile in 1600 found himself priced out of his own village by the influx of silver. That benefited only the elite. Meanwhile, the Dutch and the English built ships. They built looms. They built the productive capacity that Spain ignored. When the flow of silver slowed, Spain had nothing left but debt and inflation. The economic hegemony shifted north to the nations that produced value rather than just extracting it, just like the Spanish Empire. The British Empire in the 20th century provides the most modern blueprint for this decline. In 1914, the British pound was the world's reserve currency. London was the world's banker. But to world, wars exhausted the treasury. Britain shifted from being the world's greatest creditor to its greatest debtor. By the 1940s, British industry was aging and inefficient. The United States, the rising challenger, had the factories, the gold and the oil. Britain tried to maintain its global footprint through the sterling area, a closed trading bloc, but the arithmetic was against them. They had deficits they couldn't fund. The market tested the pound relentlessly. It culminated in the Suez Crisis of 1956 and the devaluation of 1967. A clerk in London saw the purchasing power of his savings evaporate not because of a war, but because his government had lost the economic leverage to dictate terms to the world. The torch passed to the United States not by permission, but by economic gravity. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money and high productivity, where the nation produces more than it consumes and accumulates real wealth. Stage 2 is the expansion, where the wealth is used to build global influence and military reach. Stage 3 is the peak, where the cost of maintaining the empire begins to exceed the income generated by it. Stage 4 is the turning point, where the leadership, unwilling to cut spending, begins to use debt and currency manipulation to cover the deficit. Stage 5 is the acceleration of inflation and the hollowing out of the domestic industrial base as financial engineering replaces engineering. Stage 6 is the loss of confidence, where foreign nations and domestic savers begin to exit the currency and move into hard assets or rival currencies. Stage 7 is the reset, where the old order collapses and a new economic reality is established based on the actual distribution of productive power. Just like the British Empire before it, the United States currently displays every hallmark of the later stages of this cycle. Current data suggest we are deep in Stage 5. Transitioning to Stage 6, the United States retains the exorbitant privilege of the dollar. But look at the challenger. China's economy, measured by purchasing power parity, has already surpassed the US. They are the world's factory. They process the rare earth metals. They build the ships. They dominate the supply chains for green energy and advanced manufacturing, while the US economy is heavily weighted toward services, finance, and consumption. China's economy is weighted toward production and tangible assets, the incentive for the rest of the world is shifting. Nations in the global south, seeing the weaponization of the dollar, are looking for alternatives. They are settling trade in yuan. They are buying gold. They are asking why they should hold the debt of a nation that consumes more than it produces. There is a counter-argument, of course. Many economists argue that China is uninvestable. They point to China's aging demographics, their real estate bubble, and their opacity. These are valid points. China has significant internal problems, but this argument misses the fundamental dynamic of the Thucydides trap. The challenger does not need to be healthy. They only need to be healthier than the incumbent relative to their size. The sheer mass of an $18 trillion economy creates its own gravity. Even with slower growth, China is adding an economy the size of Australia to its GDP every few years. The risk is not that China replaces the US overnight. The risk is that the US, burdened by debt and inflation, loses the capacity to deter the challenger. Under these constraints, the rational move for global capital is diversification, and diversification away from the dollar is, by definition, a decline in American supremacy. History shows us there are only 3 endgames for a cycle of this magnitude. The first is controlled decline. This is the British path, a slow, managed retreat from global dominance. Living standards stagnate, influence wanes, but society holds together. The British accepted their reduced role after 1945, anchoring themselves to the new American power. The second endgame is chaotic collapse. This is the Roman path, the refusal to accept the new. Reality leads to desperate measures, price controls, capital controls, authoritarian crackdowns. The currency is destroyed completely and the empire fractures into smaller, competing fiefdoms. The third endgame is reset and restructure. This happened globally in 1944 at Bretton Woods. The world powers gathered to write new rules that reflected the new balance of power. Debts were forgiven or inflated away. Currencies were repegged. Winners were crowned, and losers were liquidated. In every single instance, the nation with the largest gold reserves and the largest manufacturing base dictated the terms of the reset. The only variable is timing and pain. subscribe to the channel, study the supply chains. Understand that in a shift of this magnitude, the only safety lies in resilience, tangible value, and the ability to adapt to a world where the old rules no longer apply.